Hi. At Coffee Can PMS, we essentially follow a fairly simple investment philosophy, which is to buy good companies and then hold them for a very long period of time to make great returns. Inherently, at the heart of the investment philosophy are two key parameters: the quantitative filters and the qualitative parameters. Part of it is discretionary, part of it is not. As far as the quantitative parameters are concerned, we look at companies which have exhibited consistent revenue growth and consistent returns over a certain hurdle rate in the last 10 to 15 years, which essentially is a testimony to the industry growth potential, the competitive advantages that the company has, and the management track record in the past. And that's essentially the first step where you filter the companies out, where you differentiate from the men and the boys. And once the muster is passed, they form a part of our coverage universe, the so-called core coverage universe. Now, even now, not every company is essentially going to make it a cut into a portfolio, which is where the discretion of the fund manager comes into play. And personally, I look at essentially key three things, which would decide whether the company is going to get into my portfolio or not. The first one is going to be the industry growth potential. How cyclical versus structural is it? The regulatory interventions, external environment factors which are going to determine or hinder the growth. And the more structural the story, the better the chance of it making a cut into our portfolio. Paints is one example, personal products is another example, banking and finance is a third example, but something like an oil and gas will probably never do, something like a utilities will never do. And once you've zeroed in on the industry where you are sure that it's a structural growth industry with minimum regulatory interventions from a long-term perspective, you look at market leaders within those industries, preferably oligopolistic structure as far as competition is concerned. The company should have a clear competitive advantage, the hunger to gain market share, even if they are in a leadership position. And once those two parameters are fitted in, the third and the most important parameter that you look at is corporate governance. Top-notch accounting policies, no corporate governance issues, the quality and the composition of the board of directors should be top-notch. And inherently, we believe that once all these parameters are set and the company passes a filter, you have a winner at hand. You buy these companies as a portfolio inheritance perspective and you hold them for a very, very long period of time to basically compound returns out. So point number one, do we make any exceptions to the quantitative filters of consistent revenue growth and return ratios that we have set for ourselves? Do we ever make an exception to that rule? Normally we don't, but in Six Sigma cases we actually do. This is where exceptional circumstances rule apply. Case in point being Nestle. Because of the Maggie incident which broke out a couple of years back, the earnings of the company got completely derailed, so that quantitative parameter which was set for the universe selection rule, 10% revenue growth and 15% ROE, was not being met. But yet it features into our core portfolio of 11 stocks because inherently we believe that it was more of an unavoidable circumstance because of external environment which came into play, but it was inherently not the company's fault, and it did not alter the long-term growth prospects from any possible manner at all. If in fact it was more of an opportunity to buy into the stock out because of the weakness, but nothing else. So we normally do not, to answer the question in one line, but in very, very rare cases, in Six Sigma cases, we will make an exception to that rule. So what should investors be expecting from Coffee Can? Essentially, at the heart, two key things. One is consistent returns. We try and deliver around 20% of returns over a long period of time on a compounded basis, which is basically our earnings expectation from the universe of the stock on a weighted average basis. We are not looking at a further incremental re-rating of the stocks from these levels. If at all that happens, it's a bonus for you. But at least 15 to 20% consistent return should be delivered irrespective of the market conditions, the macro and the micro environment. And second, what you should expect is the churn to remain at a minimum level. For the last 18 months, the churn has been zero. In the foreseeable future also, we've tried to keep it as minimum as possible so that there is consistency in the portfolio. The monitoring is easier, and second is that your cost in terms of the trading costs are minimized completely.